The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Inflation concerns abate and the U.S. stock rally, well, it picks up steam. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And I was off last week, but it looks like we closed out on an 8th straight week of gains for the S&P 500, a rally that continues today. The S&P 500 higher by about 0.5%. A lot of that strength is coming from tech, particularly from the chips. You can see the Philadelphia Semiconductor Index higher by 5% at the moment, but it's not all just the big names at the top here. You can see the Russell 2000, which is comprised of those small cap stocks, also rallying pretty mightily as well, higher by about 1.5%, even though you do have oil a little bit higher here, Romaine. You can see we're below $100 a barrel on Brent, but still higher by about 3.5%.
Yeah, Katie, and the investors really do seem to be placing their bets on some sort of a peace deal between the U.S. and Iran. And while that in and of itself isn't the fundamental case to push equities higher, it does remove a big overhang that had, well, maybe kept some investors cautious and restrained from their buying. Now, Yoseloff and his team of J.P. Morgan strategists making the case today that with the belief that the U.S. is intent on finding some sort of an off-ramp, bond yields and oil prices are set to be lower in 6 to 12 months. You combine that with the corporate earnings outlook that should stay strong, and guess what? That equation could lead to rate cuts, at least so the argument goes. For now, traders, though, they're still pricing in more than a 75% chance that the Fed will raise rates this year rather than lower them. In New York, former New York Fed President Bill Dudley, he's throwing cold water on the idea of any sort of a cut, saying that the case there is, in his words, very, very weak, given the recent re-acceleration in consumer inflation price growth that has been above the Fed's 2% target for 5 years and counting. We get another update on inflation in just 2 days with that PCE report for April, which is expected to remain elevated because, Katie, of those higher gasoline and food prices.
Well, with that in mind, let's take a look at the 10-year Treasury yield and sort of dissect it a little bit here, because we're taking a look at what has been the underlying forces since the start of the Iran war. You're taking a look at 10-year break-even rates. That's in blue. That basically is inflation expectations. And then you have the real yield change since, of course, the start of the war. That is in white here. And you can see that it's real rates that have really been driving the move at a nominal level. They have definitely moved more and higher than break-even rates in total. So real yields, again, they strip out the basically effect of inflation. And the chart behind me really poses the question, what does that mean for valuations when you think about this record run in the equity market? Certainly, that's the question being posed by the bond market. I'm not sure if the equity bulls are really even listening here, Romaine.
Absolutely. Well, let's kick things off with Jurrien here on this holiday-shortened trading week here in the U.S. He's the director of global macro for Fidelity. And Jurrien, all the talk today seems to be this idea of some sort of off-ramp for the U.S. and Iran from this war that is now well past its second month. And right now, a market that seems to be looking past whatever sort of longer-term ripple effects. I am curious, from your view, where you sit right now, given how resilient markets have been in the face of the closure of the Strait of Hormuz and everything associated with this, is there a reason to be optimistic here that with the peace deal, maybe that big overhang that had been restraining markets is finally gone?
Certainly some sense of certainty in a good resolution, if you will, would be a big relief for the markets. The markets have been riding sort of both tails, right? We've been in a world where the middle of the bell curve distribution really hasn't been doing very much. And so it's the left tail of higher rates coming from higher inflation, coming from a long-term bottleneck in the supply of oil, which of course has been a big theme in recent weeks. And then the right tail, of course, is the big capex boom, the AI boom. Earnings have just gone vertical. We've rarely ever seen a Q1 earnings season or any earnings season where earnings estimates went from plus 14 to plus 27% growth in the span of a few weeks.
Yeah.
So we're riding both of those tails, and if the left tail can be removed, meaning the 10-year doesn't break out above 4.5%, then I think that would kind of keep that right tail intact, and we can continue to have a very good market. But it's worth remembering that at 4.5% on the 10-year, the 10-year has a PE, if you will, of 22. The S&P 500 has a PE of 22 as well. And this is why 4.5% is such an important level. There's nothing magical about it, but if the 10-year would go to 5% because inflation pressure persists, for instance, the stock market would have to derate towards a similar PE, which doesn't mean that the market goes down a lot because earnings are offsetting that. But that's the dynamic we're dealing with right now.
Yeah, it's a really interesting cross-current, Jurrien, because as you point out, earnings have been broadly excellent, but then you take a look at what's going on in the bond market. Rates at that 4.5% level, meaningfully higher than where we started March. And then you think about oil, too. Even though it's calmed down in recent weeks, it seems to have stabilized. Still, it is meaningfully higher as well from where we were heading into this conflict. So I just wonder, what is the catalyst to sort of bring these asset classes sort of back in alignment with each other?
Well, so it's interesting. If you compare a chart of the Bloomberg Commodity Spot Index to the 5-year TIPS break even, you will see that until about a few months ago, those two charts were in lockstep, right? So when things were quiet before the pandemic, they were both acting the same way. Then in 2022, when inflation spiked, of course, the Bloomberg Commodity Index went up and break-evens went up with it, and then they both went down. Now the Bloomberg Commodity Spot Index is by a mile at a new high, and the 5-year TIPS break-even is still sitting there at about 2.5, 2.6%, as if there's nothing to see here. So that's something I'm keeping an eye on. But as you point out, it's been all real rates, right? The term premium is now testing the high levels of the last few years at about 85 basis points. Real rates are approaching 2%. So this has been a real rate move. And let's hope we don't, on top of that, get unanchored inflation expectations, because then you can easily get to 5 or beyond.
Well, I am curious, though, too, when we talk about the yield picture, and you obviously dovetail that into whatever sort of cash flow projections people are trying to make with some of these stocks, we'd be remiss in pointing out that most of the stocks that are moving this market are trading on, let's just say, multiples of what the future is supposed to bring. In fact, today, 8 of the 10 biggest names are basically in that AI chip space, if you will, Jurrien. And I am curious as to how difficult it is to even place a valuation on some of these names when we're basically making a bet, or at least not me, but the investors out there are making big bets on what AI brings.
Well, the way I think about it is there are macro forces at play that explain the overall valuation in the market, and that show that the market is not overly stretched. So if you look at operating margins, earnings growth, of course, which those two are related to each other, and credit spreads, which are near all-time lows, 74 basis points for investment-grade corporate spreads. When you throw those three things together and you regress it against a PE or an equity risk premium, it explains a lot of where we are. And even, I always chuckle when some of my more bearish friends will point out the Warren Buffett indicator, the market cap to GDP. Indicators like that, or a 10-year CAPE ratio, do not factor in what's happening to margins, for instance. And margins were at 5% in 2009, and they're 16% today. That allows for the market to be more expensive because investors are getting more of their money, to work for them. So by those measures, the market actually isn't that expensive, but those forces need to continue to drive the train, of course.
All right, Jurrien, always great insights. Yih-Tennant, Director of Global Macro for Fidelity, kicking us off to the close here on this Tuesday afternoon. The stock set up for another record-setting day. When we come back, a broader discussion here about what we're seeing in the private credit space, and it does link to what's going on in public markets with all of the concerns about a SaaS apocalypse. A conversation up ahead with Tony Yoseloff, Managing Partner and Chief Investment Officer over at Davidson Kempner.
And speaking of the SaaS apocalypse, a look at what earnings out of several major software names this week could mean for the sector's performance as a whole. We break down the expectations with Rebecca Wettemann. She is CEO and principal of Valoir.
And then we're going to get into the world of real estate, luxury real estate. Jonathan Goldstein, the CEO of Cain, he's got a big project in Beverly Hills, a big transaction on Billionaires Row here in New York, and a lot of questions right now about how the alt space is evolving. All that and more coming up in a bit, right here on The Close. This is Bloomberg.
Hedge funds are reversing course on U.S. tech stocks, turning into net buyers of information tech as of last week. We have data from Goldman Sachs Prime Desk showing that long buys are outpacing short sells, with U.S.-listed ETF short positions falling 4%, which was the first such decline in about 3 weeks. Here with more insight on the data behind hedge fund and Wall Street positions is Nancy Allen. She is Managing Director and Head of Data and Insights over at EquiLend. Nancy, first off, it's great to have you with us. And I want to just set the scene here because we talk about the S&P 500 at record highs. What are you seeing in terms of securities lending activity? I mean, is there an appetite to short in this type of market, or are people just steering clear?
No, there absolutely is, and thank you for having me. The securities lending industry last year grew 26%. We came in at $15.3 billion in revenue earned on behalf of the long holders of securities who are participating in the securities lending market. And whenever there's volatility in the markets, we see activity increase significantly in the securities lending businesses. And there's a real focus right now on the AI and infrastructure have been two of the hot markets.
So talk to us a little bit about, those long stock managers, securities managers who are potentially profiting here. I mean, how does this period compare for those fund managers compared to maybe this time last year?
Yeah, this year we're already pacing, we're 34% of where we were last year. And as I said, last year we were 26% up on 2024. So it's a really good way for those long holders of securities to put their idle assets to work. And what we're seeing is what you see in the securities finance market is a lot of a real-time view into conviction and positioning in the market. So it's a way for long holders to earn incremental securities, incremental revenue, but then also there's a real view into what's happening in real time in the market. Our data speaks before the market does.
Well, that's what I'm curious about. I mean, let's take, for example, the situation in Iran. We kind of know what the trade was immediately after the bombs started dropping in late February. I am curious as to where you see things right now. Are people unwinding those positions, or are they still kind of holding on to this idea that we are going to continue to see elevated oil prices, gas prices, et cetera?
Yeah, I think the conviction in the market is still there from that perspective, especially the airline industry. We continue to see a number of the airline stocks at very high, what we call utilization levels. So when we look at utilization and we look at fees, those are real signals of how strong is conviction on those names. And we're definitely seeing there are certain energy names and oil names, and also airline names that are holding that strong high utilization and high fees.
One of the other big themes, the obvious theme, obviously, of this market has been the AI trade. And I am curious. I saw some reports from EquiLend earlier this year kind of talked about kind of the trade, the crowding in that AI trade, and as how it's kind of becoming this sort of a sorting machine, if you will. But that trade does seem to have broadened out, certainly over the last few weeks. And investors seem to be looking a little bit more far afield than just whatever the NVIDIA flywheel was for the last 2 or 3 years.
Yeah, absolutely.
Yeah.
It's been very interesting. The data has told quite a story. It's a very bifurcated market when you look at shorting and positioning in the market. You have your big hyperscalers, your Amazons, your NVIDIAs, where there's very little short interest. There's some hedging going on, but the utilization rates are very low, like less than 1%. And the fees are what we call general collateral, 20 basis points. But then you look over at some of the AI adjacent names, like Infosys is one of them, which is was our #1 earner so far this year, an Indian IT company, and there's strong negative conviction on those names. So it's the AI adjacent, it's some of the AI play names where we're seeing high utilization and fees in the thousands of basis points.
So you point out Infosys. You write in your notes that you sent over to our producers that that has been a top earner year to date. Talk to us too about Wolfspeed, which is another name that you highlight. What's specifically going on there?
Well, Wolfspeed is really interesting. So they're a semiconductor. They had a lot of issues. They had a restructuring last year. They filed for Chapter 11 bankruptcy. But then recently, in the last couple of weeks, they've been reclassified as key AI infrastructure. And we saw the stock price jump 130% in the last month. But what we saw in the data is we saw ahead of that announcement, that research advice, we saw our squeeze score going up. We saw positioning in the market. We saw some shorts coming off, potentially as that price started to increase. And now we're seeing the shorts are back on. The fees are going up. So it shows, it costs money to take a position. And so when you're willing to pay to keep your short on, you have real conviction in that name.
Well, with regards to those, some of the, I guess, more traditional kind of software as a service companies and that whole fee model, we've talked a lot on the show about the SaaS apocalypse. And we've seen the sell-off in those names. And you've seen somewhat of a rebound over the last couple of weeks as people maybe thought it went a bit too far. But is there still relatively dour sentiment with regards to some of those names?
I think it's company by company, so you need to look at the fundamentals. But there are certain companies that are definitely seeing more short interest than others. I think the Infosys is an interesting one. On the industrial side, the EV battery names are also coming under a lot of pressure. We had Contemporary Amperex was one of the top earners this year so far. So it's really very, very name driven, but industrials, IT stocks as a whole is our highest earning sector or industry so far this year.
Okay, Nancy, great stuff, great insights and great data out of Nancy Allen, Managing Director and Head of Data and Insights over at EquiLend. Now, when we come back, we're going to turn to the earnings season, which is tailing off, but there are quite a few names in the retail space that are set to report this week and next. A bit of a read here on the state of the consumer. That conversation coming up next here on The Close, right here on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. Let's start this one off today with the big one. Apple. Bank of America raising its price target to $380. The analyst says in an agentic world, value accrues to the platform that controls app access, authentication, payments, and trusts everything the iPhone has. He does see some execution risks, saying it will be important to make Siri the execution layer for AI. Nevertheless, those shares, which had been trading at a record high, now dipping into the red. Next up, let's take a look at Micron, a big one. UBS boosting its price target to a street high of $1,625, a doubling of the company's market cap over the next 12 months to $1.8 trillion due to persistent demand for memory chips. Those shares up again to a record high. And finally, Burlington. Barclays raising its price target to $411, maintaining an overweight ahead of the retailer's earnings later this week. Analyst Adrienne Yih says store checks on Burlington have been consistently strong, and she sees high conversion, especially in their newer stores. Nevertheless, the shares slightly lower on the day. Pleased to say that the analyst behind that last call joins us right now. Adrienne Yih, Managing Director and Senior Retail Analyst over at Barclays. Adrienne, great to see you again. Let's start off with Burlington, not the Code Factory, just Burlington these days here. They've actually surprised to the upside the last couple of quarters here. What gives you the conviction here that they can continue that?
So I'll start off with just talking about the environment right now. We're in a consumer pressured environment. They target a lower household income, sort of in that 50 to 60,000 household income. We have already seen evidence that the off-price model is working in spades, right, from TJX and from Ross that went last week. And then with Burlington, you layer on top of that very company-specific kind of, and I don't want to say a turnaround, but it's a perfection of the off-price model. As you said earlier, they started their journey as a mass merchandiser of coats. And then about 10, 12 years ago, they actually transitioned into this off-price model. So during the past 5 years, they perfected that model, and they're now kind of aiming right at that consumer with great value and elevating their stores, their brands, everything that you expect an off-pricer to do in this environment.
I am curious that when we got some of the earnings last week from some of the off-price, it was kind of a mixed bag though too. I mean, some of them, TJX obviously always does well, but then you heard from Walmart, which I know isn't necessarily under your coverage, but they talked a lot about the potential price pressures on their consumer in the second half of the year. Is that not a concern for you at all?
So for the off-price sector, it's not a concern to the extent that really what this consumer looks for, particularly at the lower end, is a stretching of their dollar. And what they want to get, and you and I have talked about this many times, is the notion of value. And value doesn't mean cheap, it means kind of price paid for quality received. And you can stretch that dollar in the off-price arena. Let's remember that Walmart is primarily food and grocery. That's kind of not as much discretionary. And where the off-pricers fall is what I call need-based discretionary. Things that you actually need for the household, and yet they aren't groceries.
Well, let's talk a little bit about the broader environment here, because there's a lot of focus, of course, on what's going on in energy and how that is translating through into gas prices. You think about where we stand basically above, on average, $4 a gallon here. How does that typically translate into shopping behavior? What does history tell you about what that sort of link looks like?
Katie, that is a great question, and it is the question of the moment. We are sitting at the juncture of kind of what I call driving by the rear view mirror. So if you look, everything year to date has been very pristine, clean inventory, low promos, stimulus, consumer seems resilient. And then the forward look, we just started to see the gas prices go over $4 a gallon in early April, right? And so the forward look is definitely tenuous. If you look at sentiment, if you look at inflation, all of those things are starting to perk up. March and April were driven by that oil and that gasoline. And what happens here is that the demand erosion takes some time to work through your wallet, right? You need to go fill up 3 or 4 times at $100 a pop to realize you're spending $500 on gasoline to get around. That then changes your perspective and the choicefulness in what you're going to do with your wallet. So we don't think we're out of the woods. And if you look at kind of where the sector, U.S. specialty discretionary thing, where it's trading relative to the S&P, it could not be at a lower relative valuation. It's even lower than where we were in the GFC. And I think that's telling you something about investors' appetite to take on that demand risk.
All right, Adrienne, really great to get a preview of the week's action with you. That is Adrienne Yih. She is Managing Director and Senior Retail Analyst over at Barclays. And it's a really interesting point that you think about that demand erosion. Maybe we haven't seen it yet. Maybe we're not going to see it in the numbers we got this week. But eventually, if we stay at these levels, it will come.
Yeah, and that's the fear here. And the question then becomes, does this become sort of a, I guess, lower tide lowers all boats? Is that a thing?
You're close.
Or do you have some sort of winners and losers in all this?
Absolutely. Well, we'll be
I'm not good on euphemisms today.
Euphemisms,
You've
metaphors.
been gone for a while.
I was in Ireland. It was awesome. I came back a year older. Coming up, though, we're going to talk about this market, the current conditions, and the future of tech, and so much more with Tony Yoseloff. He is Managing Partner and Chief Investment Officer.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. And of course, earnings season, it isn't over yet. We just talked about the retail earnings that we're going to get in the days ahead, but also a few software names towing the line, including Salesforce tomorrow.
Yeah, I mean, they are kind of the benchmark for the software as a service business model, a business model that everyone seems to think is going to continue to be under pressure because of all these new AI tools that keep coming out. But if you hear Mark Benioff talk about it, he's saying, look, that's no problem. We've already made our pivot to agentic AI, agent force, as they call it here.
Yeah.
And they're going to be players. But as you see, not only for them, but for all the names we have on the screen here, a lot of big question marks here about how viable and durable those models are. Definitely.
And you can see that in the share prices when it comes to a lot of these names, Salesforce in particular. Take a look at the stock's performance year to date, down 32%. So a little bit of skepticism, probably it's fair to say.
All right. Well, someone who has, talked about that skepticism and more importantly, looked for opportunities in it, joins us here in Studio 2. Tony Yoseloff is Managing Partner and Chief Investment Officer over at Davidson Kempner. Great to see you, Tony.
Great to see you as well.
I do want to start off with what's happening in the software space. And I understand there's still not a lot of visibility, but everybody is sort of looking not so much just at the durability of these business models, but obviously all of the money that's been backing these companies, whether it's in the private equity space, the private credit space, or even in public markets here. Is this sort of a real crack in that business model, or is this kind of a one-off where we'll maybe see a couple of companies here and there succumb to whatever AI is going to bring with regards to these tools?
No, it's a real crack in the business model. I mean, as a starting point, like no one really knows, right? And you take a business, software, that historically was a very high multiple of business. These businesses traded at very high multiples of EBITDA. And they did that because it was a certain business. You could have your customers come back every year. There was very high retention rates. There was high certainty of increasing your cash flows over time. With the introduction of agentic AI, that's all gone out the window. And so you've seen a dramatic decline in multiples in these businesses. Software businesses in the public markets that traded in the low 20s EBITDA multiples at their high point in 2021 or low teens today. Multiples in the private markets, which would have been in the mid-teens EBITDA in 2021 or in the higher single digits today. That just reflects where things have come. There is a big difference, though, between what's going on in the public markets and in the private markets. The public market businesses tend to be the better, higher quality businesses within software. The businesses in the private markets tend to be lower quality businesses and deserving of lower multiples. That's why you've seen that differential between them. On top of that, software is only 7% of the S&P, whereas software investments were high 30s to approaching 40% of private equity investments done over the last 5 years, and they were low 30s% of direct corporate lending investments that were done. So it not only are the businesses worse that sit in the private markets, but it has a much bigger impact on those markets.
Well, on the private equity side, I saw one statistic just last year alone. That number was like 41% in terms of PE money going into software. And I guess, does that set up some sort of, I guess, kind of real collateral event if we do start to see the valuations of these models drop?
Well, I do, and I think it's relatively simple. I mean, my truisms of investing are capital chases returns and markets become efficient over time. It's hard to get away from those things. The reason that private equity dollars poured into software is the best returns of the second half of the 2010s and early 2020s came from software investments in private equity. So a lot of people therefore chase those investments. That coupled with, say, a black swan of what's happened with the implementation of agentic AI and coding being much cheaper and easier than it was previously, it's just led to a complete change in that business model. Newspapers went through this. Wireline telecom went through this. It's not limited to software, but when you go through that, you tend to never get back the higher multiples you've had previously because there's just much more uncertainty around the cash flows. The one big difference between the public markets and the private markets is there's a lot of natural defenses in the public markets to this. So again, software stocks are down enormously, as you mentioned earlier in your segment, but the S&P is at an all-time high. Like, why is that happening? Because there are plenty of other winners in the public markets to make up for that. In the private markets, because such a big portion of private equity and direct corporate lending went into software, it's just harder to come back from that because you don't have the same winners. And the really big AI winners that sit in the private market, so companies like SpaceX or Anthropic or OpenAI, they tend to sit in growth equity funds and venture capital funds, and actually they sit in hedge funds. They don't generally sit in private equity funds.
Well, you know, you think about private equity, you think about the exposure to software. Tie that into a paper that I saw you authored back in March, talking about how you think about private equity and you think about your allocation to opportunistic credit, how at this point that perhaps favoring opportunistic credit over private equity made sense. How does software sort of tie into that thesis?
Well, I think there's two parts of it. First of all, as a general asset class, opportunistic credit often combines equity-type returns on the upside with credit downside protection, and it tends to be a shorter duration asset class than you have in private equity. Private equity returns over the last 4 years have been abysmal as companies are digesting the period of time of higher interest rates. That's all pre-software collapse, by the way. I think the benefit of doing an opportunistic credit strategy is you can go to the asset classes that are most interesting in a period of time and the geographies that are most interested in a period of time. So you're not just wedded to one asset class or one industry. We're obviously going through a period of time of tremendous change within software, but you're going through a time of tremendous change within levered capital markets because of the rise of interest rates. I mean, the markets really still have not fully digested where rates are today compared to when many of these deals were done in the 2019 to 21 period of time. That takes several years to work itself out. You have a lot more flexibility there. So the conclusion of our paper is that for a portfolio, you actually are better off having some opportunistic credit in your portfolio because you can overall increase your returns of your portfolio without increasing the volatility that comes with the portfolio itself.
We'll expand a little bit on what you were saying about geography, because we're very well versed in the story when it comes to the U.S. But I mean, what opportunities are you seeing in Europe? How does that compare to what you're seeing stateside?
Well, it's really both Europe and in Asia. I mean, look, Europe has a lower growth economy, and the country by country nature of Europe, coupled with the regulatory environment that you have there, tends to mean that you enter at lower multiples and you exit at lower multiples. And you can see that in stock prices. If you were to look at European stock prices today compared to US valuations and strip out the tech stuff because you don't have that in the same way in Europe that you have in the US, you're still at the bottom 5 or 6% in disparities among those, AKA Europe is cheap. But Europe is much more of a bank-led market compared to the US, and so the great majority of leveraged debt in the US sits in investor hands. The great majority of levered debt in Europe still sits in bank hands, and so your counterparts are often banks, they're not investing funds, and that sets up really interesting opportunities to do restructuring or provide creative capital in those markets. Asia has massive dispersion in it, and so for us, Asia is much more of a public securities market than a private securities market, although we are very active with new issue lending in India. And that market, in different ways, still hasn't fully recovered from the pandemic. And so you're getting really good dispersion between markets and opportunities there. The U.S. is an amazing market to invest in, but everyone has come to the U.S. The amount of FDI in the U.S. has doubled as a percentage of FDI since the pandemic. And so, again, if you can go to markets and invest in markets where maybe there are fewer people playing, you can take better advantage of those inefficiencies. There are a lot of structural barriers to doing that as well. You need a team in place, you need to have local relationships, local language skills, be from the local market and get to know them over a longer period of time. So even if you want to do this, it actually can take quite a period of time to build this up as an investment manager.
I am curious, though, back here in the U.S. with regards to some of those inefficiencies and the idea that, I mean, there is going to be some sort of restructuring take place with some of these firms here in the U.S. And I am curious about this idea, not so much of whatever the recovery rate might be on some of those, but the idea that you have interest coverage ratios that are relatively low, at least by historical measures, and the idea that there are going to be people looking, you know, maybe knocking on your door for some sort of help. Are you willing to do that?
Yeah, I mean,
as an investment?
We're probably 2 to 3 years into this story happening already. If you look at the true look-through default rates in the U.S., and so I'm including liability management exercises, so i.e. borrowers going to their lenders and either saying, we can't pay you back or we don't want to pay you back in full. And there's a private market equivalent, which is called involuntary picking of loans, where, again, the lenders all got together and say, you don't actually have to pay this cash interest that's currently due when it's due. Those default rates are at 5 to 6% already, and they've been there the last couple of years. And those default rates are ticking up. There's been Moody's and Fitch reports on that recently. So those aren't going away. And so there's multiple ways that you can solve that problem. Just because a company can't pay its debt when it comes due or pay its interest currently doesn't necessarily mean it's insolvent, like there's no equity value. So there's a lot of ability to provide financing dollars to help solve those problems. There is the ability to buy capital structures outright, and there's an ability to buy assets from companies that are looking to delever.
Right.
All of that has gone on already, and it's gone on because of the rate story and maybe some of the lower growth story in these capital structures. And it's gone on at rates that are very similar to what actual default rates were in the 2000s. You know, 90% of debt in these structures is covenant light or no covenant. So borrowers are doing what they're supposed to be doing. They're not just turning over the keys. They're actually playing out their options. That doesn't work often, but it works occasionally. So I think there'll be even more of these things to come, but I think we're in that environment that's pretty ripe already.
And Tony, we only have about a minute left. I do want to switch gears here and ask you about a court filing that did land in mid-May that Bloomberg News reported on about a dispute with a one-time senior partner over at Davidson, Kempner, basically alleging that, you know, the way that you're running the firm is similar to a personal family office and other details in there. And these are allegations, but I am curious, you know, how do you respond?
Yeah, I mean, I'm sure you're aware of the fact we're not going to comment on any ongoing litigation. We're at a number of litigations at any point in time, and this isn't going to be treated any differently than any of the others. So,
all right, fair enough. Well, Tony, a wide-ranging conversation. Really appreciate you taking the time and coming to studio. That is Tony Yoseloff. He is managing partner and chief investment officer over at Davidson Kempner. Now, coming up, 2026 has been one giant shopping spree for pharma giant Eli Lilly. A full breakdown of its latest acquisitions in today's Stock of the Hour, up next. This is The Close on Bloomberg. Well, it's time now for our Stock of the Hour, and we're keeping an eye on Eli Lilly as the pharma giant announces it's buying 3 clinical stage vaccine developers for as much as $3.8 billion. Now, this is part of a larger shopping spree that we've seen from Lilly, which has announced more than $20 billion of acquisitions so far this year. Here with the context is Bloomberg TV markets correspondent Nora Melinda. Interesting to see shares of Lilly higher today, actually on the heels of that announcement. And Eli Lilly, we know them for their weight loss drugs, but it's worth pointing out that they're spending aggressively outside of just that area.
Well, they're trying to diversify, especially if you think about the stiff competition that they have from competitors like Novo Nordisk on that weight loss drug front. So we know that this is a company that has been involved in other sectors of drugs when we think about infectious disease, which is what we've been focused on in this most recent deal that we're talking about today, the three that we're talking about, infectious diseases. They've been involved in that in the 1940s, but they kind of shifted some of their outlook as they were heading more recently in recent years. So that being said, we're seeing them really trying to diversify and not necessarily hinge all of their pipeline entirely on an emphasis on obesity drugs and, of course, diabetes, which they're known for both of those sectors.
Well, that's what I'm curious about. I mean, how diversified is their business now, at least relative to some of their other competitors in the weight loss space, like Novo Nordisk?
Mm-hmm. Well, what I find to be particularly interesting is they are, clearly trying to underscore that diversification, and we have seen a lot of emphasis in terms of them relying specifically on and doing really well when it comes to the weight loss space. But what I find interesting, too, is the fact that they do have a lot of cash on hand for these deals. We talked about $20 billion in deals in this year alone, but they do have, at the end of 2025, about $7.3 billion in cash on hand. So it seems as though they do have the funds to help finance some of these deals that they're interested in. But you still see the street having these high expectations for a company that's sitting around $1 trillion in market cap.
Well, it's interesting when you compare the stock compared to Novo that really beginning over the last several years, you've really seen Eli Lilly break away. And then you have Novo Nordisk just trending lower and lower, sort of an alligator chart there, if you will. So just talk to us a little bit more about that, the fact that you do have Eli Lilly, again, spending so aggressively, trying to diversify. But then you think about what's going on in these different share prices. So far, it seems to be still very focused just on GLP-1s.
Absolutely, and that's what's been topical as of late. But we also are seeing a shift in focus where we're seeing Eli Lilly spending a lot of money on some of these early stage growth drug companies. So maybe not a blockbuster drug that they're necessarily focusing on anymore, but maybe more of an emphasis in early stage drugs. And so you're seeing that with many of the deals that we're talking about this week. The company also saying that they are evaluating about 10 deals a week, just saying that the volume is really insatiable. So you're clearly seeing this being spelled out in many avenues here from the company. All
right, Nora Melinda, our Bloomberg, our markets correspondent, a closer look at Eli Lilly, our stock of the hour, as we continue to count you down to the closing bells here in New York with all of the major indices, well, with the exception of the Dow, which is sitting this one out, but all of the major indices right now are posting relatively strong gains here on this Tuesday afternoon. The S&P up 0.7%, but this is really about tech stocks today. The NASDAQ 100, Katie, up 1.8%, and there's a big reason why. You got Micron up 21%, on semi up 11%. You go down the list, basically all of these names that are tied to that AI story are higher on the day.
Yeah, chip makers in particular, led by Micron, as you pointed out. You can see that in the stocks higher now by nearly 6%. The advance in Micron is pretty breathtaking. That's adding about 20 points, almost 21 points to the S&P 500.
Apparently Trump name-checked them last Friday when he was out at this event in New York. And, I guess that's all people need to hear for some reason.
There you go, name-checked by the president, of course, getting that upgrade today. So sort of a 1-2 punch that is really just accelerating shares of Micron higher on a day where you have the likes of NVIDIA down. Normally that would matter more, but not when you have, again, Micron adding nearly 21 points to the index itself.
All right, and helping out things a little bit here, of course, today is that drop that we've seen in yields and a little bit of a restrained trade right now when it comes to WTI crude. Joining us here in Studio 2 to help count us down to those closing bells is Binky Chadha, Chief U.S. Equity and Global Strategist over at Deutsche Bank Securities. Binky, make sense of this for me here. We have basically what's going to be another record high for equities. We're now something like a 9th straight week here of gains for the benchmark indices. And it's still been a story about AI, or at least the companies that are associated with AI. That continues?
I would argue tech is sort of at a turning point or, sort of it's come full circle. Well, if we just back up the tape, we have basically the Iran war, we have the S&P 500 sort of, go through what I would call is very close to the average of the playbook historically, which is 6 weeks, 3 weeks down. It's a sharp sell-off, but it's a short-lived sell-off.
Yeah.
Of course, prior to that, what we have is the best performers of the last 2.5 years, which was mega cap growth in tech and the financials. underperforming, and that is a story that goes back to the third quarter as earnings started to broaden out. And so when you're at the bottom in the Iran war, that rotation's basically gone far enough, and positioning is a big part of the story. And of course, what we got is then earnings season, and you overlay that on top, and we have basically, it's a remarkable earnings season as far as the numbers are concerned. We're talking about 25% of growth in S&P 500 earnings, way into a cycle.
Well, that's what I'm curious about with regards to earnings. I mean, it was a phenomenal quarter. There was some cautiousness with regards to some of the forecasts, but it seems like this market is now looking at this potential off-ramp with regards to the U.S. and Iran war, and the idea that some of the upward price pressures on the consumer that some of these CEOs were concerned about in the second half, that might abate enough to make sure that the second quarter earnings season, third quarter earnings season, et cetera, are just as strong, or at least on a relative basis.
If you look at the bottom-up consensus, it's quite remarkable. It has, high teens growth for each of the remaining 3 quarters of the year. So I would argue that's the main reason to be constructive and bullish equities. Now we've come, as you said, a long ways very fast. But we're sort of almost in the middle of the year. Market's up a little less than 10%. That's not really very unusual. Yeah. And so the question is, what happens? From here until through the summer and after. We have a midterm election that is likely to get more and more attention, basically, and be a source of, potential volatility. I mean, the typical pattern is for the market to buy protection around the midterm election, so the market starts to go sideways to down, depending on how unclear the results ex ante are and how much protection it buys. And then once the election is over, as long as it's settled one way or the other and clear, the protection comes out and the market rallies into year end. Typical midterm election year. So last 23 midterm elections, 21 of them have seen positive fourth quarter, average 7%. That's a very healthy number.
Yeah, so history on the side of the bulls here, but we have the midterm elections coming up, as you point out. We also have a potential wave of IPOs coming up as well. And not just any IPOs, mega IPOs. And I wonder, you talk about a little bit the supply-demand imbalance when it comes to equity issuance. Certainly, we've been a little bit starved of supply when it comes to the equity market over the past several years. How do you expect that balance to sort of shift as we get these big companies, enormous companies, finally coming public?
Yeah, the first thing to note is that, equity issuance sort of bottomed in 2023. That's soon after 2022. That's Russia-Ukraine. That's the aggressive Fed hiking. And it's been coming back. So in dollar terms, it looks high as a proportion of market cap. We're not even back, basically, to the historical average. There's little doubt that the mega IPOs we are going to get is going to mean a serious step up, basically, in that uptrend or that up wave, whatever you want to call it. But I would argue, take a look at what the academic literature says, and then we'll come back to today. The academic literature says, basically, big booms in equity issuance typically happen as a result of the equity market doing well, as a result of earnings looking good, which we just spoke about. And so it's a good time to basically issue. And most of those issuance waves are, all of them are associated with very strong equity performance in the run-up to that issuance and during that issuance. So, if you have to make a bearish case, it would be way out there. What I would also point out is that, so if we take, the next one that's coming, it's, to be very precise, 0.12% of the market cap of the S&P as of Friday. We have index inclusion issues that might, but we're talking about the NASDAQ right now. NASDAQ's not such a big benchmark, basically, for funds. When it comes to the S&P, it would be a slightly bigger impact. And then there's a question of, how much of what's locked up is eventually going to get sold. But we've had big issuances before. And so I would do it and think about it in reverse, as opposed to, and we were just talking about tech. you know, so I tell you that tech soars for 2.5 years. You know, it's left for dead from October till the Iran war, and then tech picks up again very sharply, and that's when we're getting the issuance. So that's when everybody's talking about it.
Yeah, so that's where I wanted to go, because you think about the fast track inclusion into indexes such as the NASDAQ 100. I mean, there's been a lot of hand-wringing, a lot of pearl clutching over what that is going to mean for index investors and sort of the integrity of indexes overall. It sounds like when it comes to that debate, that, you know, maybe you're not as concerned here.
We are not that concerned. I mean, you know, we have a very simple demand-supply model, and if you increase supply, obviously equities go down, and it's a negative. But what we are talking about, you know, I mean, to be fair, our models are calibrated on quarterly, so gradual flows. You have lumpy issuance. It might be a little bit bigger, but, you know, that 0.12% of market cap would tell you it's around 1% because it's lumpy. It might be a little bit bigger. And what I would point out is that that's not really a pullback. That's, you know, that's almost normal volatility in equities. You got to remember they pull back, you know, 3 to 5% every 2 to 3 months. So, you know, yes, I mean, I think the fear is there and the liquidity is there and the logic is compelling, but it's not happened historically, and the numbers don't suggest that it should. So, you know, we live in a world, lots of other things can happen at the same time. So, yeah, I would argue, you know, we have a new Fed chair. That's a source of volatility. Most Fed chairs have had to deal with volatility and equities pulling back some in the beginning. So we shall see. It's not enough days since the swearing in yet.
Yeah, absolutely. It'd be interesting to see. I mean, of course, they have that big meeting the middle of next month, so we'll get a chance to see maybe what Kevin Warsh is made of. Binky, always a pleasure. Binky Chadha, Chief U.S. Equity and Global Strategist over at Deutsche Bank Securities, as we count you down to the closing bells. And I am actually intrigued by this meeting coming up. I know we're probably not going to get any change in policy, but we got a PCE report coming this Thursday, I think, that is going to be kind of probably reiterate what we already know, which is that in April we saw those price pressures start to go up because of the war in Iran, and sort of what the conversation is like behind closed doors in about 3 or 4 weeks' time.
Absolutely looking forward to that, especially, you know, it comes against a backdrop where it feels like the hawkish voices are reasserting themselves when it comes to the Fed speak that we've been getting. Certainly a lot for Kevin Warsh to sort through at his very first meeting at the helm.
Well, at least for today, yields are lower here, bucking the trend as of late. Stocks are higher, headed for a record high. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Tim Stenovic joins us from the radio booth. Alex Semenova in today for Carol Master. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube here on a holiday shortened week, Tim Stenovic, but it's a holiday shortened week that starts off with a bang.
Yeah, well, first of all, welcome back, Katie. Happy Tuesday, everybody. Look at what's going on in the stocks today. It's up another 5.6%. It's up more than 80% this year. 29 components of the stocks are higher. The only one lower right now, Alex, NVIDIA, down by 0.4%.
And we were speaking about this before this, Tim. All the more impressive is that 62% of the entire year-to-date rally this year has come from semiconductors alone. Just astounding how much of the market that they now comprise.
Yeah, it is pretty amazing there. But I do want to point out, in addition to the chip makers that are just running away with it today, that the small caps also seeing a bit of a bid as well. When you take a look at the Russell 2000 on the day, higher by more than 1%, I believe, 1.7% right now. So rallying into the close. So at least when it comes to, you know, size here, it is a big, broad rally.
Absolutely. And don't forget the Dow Transports, Katie Greifeld here. All but one of the stocks in that average now higher, actually led by some of the airlines. American Airlines up 7% right now heading into the closing bell.
Yeah, that's amazing. I guess Starlink is why People are bullish on American Airlines?
Yeah, I mean, and this is going to be interesting too. I am very curious as to the absorption of SpaceX into this market. I know people look at it just specifically from the SpaceX side, but there is a flywheel there, similar to like NVIDIA, and a lot of money is going to start to move up and down that flywheel.
Does that go into the Dow transports eventually?
I don't know, but based on our reporting, it'll certainly get into the S&P and a lot faster than any other company has probably gotten into that index. We did get the closing bells here in New York. The Dow Jones Industrial Average sitting this one out, down about 0.2%. The S&P 500, 75.19 and change, up 46 points, 0.6%. That's a record high. The NASDAQ Composite up about 1.2%. The NASDAQ 100 up 1.8 at a record high. The Russell 2000 adding 51 points, or about 1.8%, and that is also going to be a record high.
A little bit of an even split in that record high S&P 500. 251 names advancing, 251 declining.
Well, let's take a look at the sector breakdown as well here, because like Tim said, a little bit of an even split, not necessarily what you see when you take a look at the colors here, because tech dominated today. That comprises a big slice of the pie before your eyes. Tech higher by about 1.7% as a sector. Industrials also having a big Tuesday, higher by about 1.5%. Materials, communication services, some of your big gainers. In terms of what didn't perform on the opening day of this holiday shortened week, energy as a sector down by about 2.8%. Consumer staples also off by about 1.7%.
I want to talk about a chip maker on our radar today. That's Micron Technology. This is the biggest gainer in the S&P 500, up 19.3% today. The market cap now over $1 trillion, $1.01 trillion. This as a result of what happened over at UBS. They boosted the price target for Micron to more than $1,600 a share. It's at about $900 a share right now. This implies a market cap of more than $1.8 trillion, larger than the current market cap of companies like Meta, Tesla, and Berkshire. Still a ways to go, but Romain, you were going to say something. It's up close to 20% in a single day.
Yeah, and I'm just more fascinated by the $1 trillion mark. I mean, you go back a few years ago, we had $0 trillion companies, and by my count, we've now got 14 in there if you include Micron. And of course, you have the granddaddy NVIDIA, and then of course you have at least one IPO coming down the pike that we know is also going to be in the $1 trillion
That would
club.
be SpaceX.
SpaceX, and potentially a couple others with regards to the two big AI companies also potentially going to come to market this year.
Remember for so many years, Romain, it was like, what's the biggest market cap company in the world? And it was always this question about like, okay, is it going to be a Ramco, ExxonMobil, or Apple? Yeah. Times have really changed, right?
They sure have. Man.
Hey, speaking of SpaceX, there's a lot of excitement in the space industry right now. I want to draw everybody's attention over to the Procure Space ETF. Its ticker UFO. That's a pretty good one. It was up 5.7% today. We did see shares in rocket and satellite companies rally, set to extend those recent gains. It's really been advancing this whole sector since SpaceX filed for what stands to be the largest ever IPO. Among notable movers today, well, if you just go to the Procure Space IPO or Space ETF, 36 names were higher, 12 were lower. Momentus was up more than 109%. Redwire was up 26%. Citus Space up 21%. Firefly Aerospace also up 18.8%.
I'm sorry, Momentus was up 100%?
That's correct, yeah.
Okay.
That's correct. A single name, right?
Okay.
It's in the space industry.
I mean, I know it's like a micro cap, but did something happen?
This space.
Just space.
Space happened.
Vibes.
Okay.
Did you guys watch the game? The big game?
The big game?
The New York Knicks?
I checked the score.
The big game. I did hear my neighbors cheering a lot last night.
There was a lot of cursing?
No, they were happy.
Yeah.
Everyone was very happy. 3.5% up.
Well, I mean, have you met a New Yorker? They curse even when they're happy.
That's true. For Madison Square Garden. Shares off their best levels of the session, but still closed at a record. This after the New York Knicks completed a 4-0 series sweep over the Cavaliers to advance to the NBA Finals. First time, Alex, going back to 1999.
Big win for Dolan there.
What were you going to say?
A big win for Dolan there.
Oh, yeah.
Yeah.
Big win also for Timothy Chalamet.
For Timothy Chalamet.
Really
always front row.
Always. With Kylie Jenner, they're doing well.
If the Knicks do win the finals, is this city just going to become completely insufferable?
I hope so.
Like, is it going to do what happens in like Philly and Boston when there is a
They're going to have to
win?
grease the street polls. It'll be amazing.
Yeah, I mean, sorry.
I don't know. Do we have that, like...
I think the entire NYPD needs to be on patrol that night.
All right, we'll see what happens.
Overtime for everybody. Alex, what do you got?
I have to say, guys, it is not the easiest feat finding decliners in this market when most of the U.S. benchmarks are at record highs, but I managed to muster a few up for you. The first one that I'm looking at is AutoZone. It had its worst day since 2022, down 9%. The company actually beat on earnings, but its total revenue fell short of forecasts, and it reported sluggish growth in its international markets. It has stores in Mexico and Brazil, and also some margin pressures. In fact, DA Davidson analyst Michael Baker said that the company delivered its best quarter in some time, but the expectations were just too high.
All right, we are getting some earnings right now. This from cloud company Zscaler, just crossing the Bloomberg terminal. Revenue in the most recent quarter does appear to be a slight beat, $850 million. The street was looking for $8.35. Adjusted EPS at $1.08. That beats the street estimates, average of street estimates of $1.01, and recurring revenue basically in line with estimates. Here's your forecast. The company says that for the fiscal fourth quarter, the quarter that we're in right now, revenue will be in a range of $875 to $878. The high end of that range is below the average of street estimates of $879. The company also says that for the full year, which basically closes out, also guiding just slightly below what the street was looking for at about $3.74 billion. So that is probably why you're seeing the knee-jerk reaction to the downside in the shares.
Yeah, total wipeout underway in the after hours. Shares now down more than 10%. And this is a company where shares had already declined about 18% heading into today's close. So the bar had been reset a little bit lower here. But Alex, you can see that disappointment still coming through.
Yeah, and disappointment also in Ferrari. Now, I'm sticking here with car companies, which, by the way, is not my forte at all, but I'll try my best.
That's because you're a real New Yorker.
We'll have Hannah Elliott on the show later to break it down for us. But this was a fun story. Ferrari, whose ticker is RACE, which I love. It had a big down day, down, I believe it was 8%. This is after it debuted its electric vehicle, the Ferrari Luce. Investors didn't like it. Analysts didn't like it at all, and neither did social media influencers. In fact, one analyst said that the car looks like, quote, a mix between a Honda Accord EV and a Tesla 3. Apparently that was meant to be an insult.
Man,
I actually like this car.
Really?
You pre-ordered it?
Well, I live in Manhattan, so no, I'm not going to drive a Ferrari on Manhattan streets.
Well, there are plenty of places to buy Ferraris in Manhattan. I think on the west side there's a Ferrari dealer, not too far from you, just a little south, Romain.
I will keep that in mind.
Keep it in mind.
I'll talk that over with my wife, too.
Yeah.
First of all, I don't drive, you know that. But I mean, it's not that bad. I think everyone's just because, it doesn't look like a traditional Ferrari. And I know Matt Miller was apoplectic about this or something. But,
Does it have
times
the roar
change.
of the engine? I feel like
it's an EV.
I know, but with a lot of these luxury vehicles, you kind of want that audio experience as well.
Well, there's also the question about, when cars are electrified and they're all fast, what differentiates this from just any other EV?
It's very expensive.
That's right, but I mean, internal combustion engines, there's a big difference from engine to engine, but with these EVs, a Model 3 is fast, very fast.
All right.
I don't know.
Well, you can buy a Ferrari now.
Okay.
Yeah.
Sign me up. Sign me up. Hey, that is going to do it for our cross-platform coverage. Excuse me?
Does Alex,
I don't
the
drive,
person
actually.
sitting to your left?
It's my most New Yorker qualities that I don't know how to drive a car.
I love that.
So, right there with you, Romain. You mentioned that you don't drive.
I mean, I do know how to drive, Alex. I just don't.
I love that. All right, that is going to do it for our cross-platform coverage of the market close. We got to go, but we're going to be back tomorrow, same time, same place.
And our coverage continues here on Bloomberg Television. A closer look at some of the big software companies reporting this week. That conversation up next, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic, kicking off the holiday-shortened week here in the U.S. with record highs pretty much all around for most of the major U.S. indices. That includes the S&P 500, adding about 0.6% here on the day. But Philadelphia Semiconductor Index, that has continued to be the big magnet here for the market to the upside. An almost 6% gain, the best day for that index going back to early April. And, of course, also at a record high. Even software stocks, which had been beaten up, managed to hold their own here on the day. And a big part of the reason for some of the optimism, of course, is that drop that we saw in Treasury yields.
Absolutely. An interesting interplay there between the micro and the macro. But let's talk a little bit more about the micro. We were talking about this with our radio friends, AutoZone. Its worst drop since 2022. They reported this morning they missed when it comes to comp sales. Shares down about 9%. Eli Lilly, I just wanted to highlight it once again because the announcement today that they were splashing a lot of cash on some vaccine makers, $3.8 billion, which is not nothing, but still you didn't really see shares decline, which is interesting. Maybe investors giving a vote of confidence to Eli Lilly's plan to diversify the pipeline here. And just wanted to highlight Micron once more because it did surpass $1 trillion in market cap with today's 19% surge. We know that chip makers have been at the heart of this rally, even as software stocks really suffer this year. And that's our top story this hour. The SaaS apocalypse in the spotlight. Salesforce set to report tomorrow, adding to a broader slate of software reports. Now, Wall Street watching closely for signs that the company's AI offerings can help reignite revenue growth. Now, the earnings also come as the gap between the firm's marketing and real-world adoption widens. Bloomberg reporting some promotional videos show capabilities that aren't exactly widely in use yet, Romaine.
Absolutely, and it raises a lot of questions here about what the future of these companies are, given some of the advancements that we continue to see in AI. Rebecca Wettemann joins us right now, the CEO and principal over at Valoir. And Rebecca, you cover this space better than anybody. I am curious, specifically when it comes to Salesforce. And we know Mark Benioff, always the optimist, always the guy who thinks he can sort of solve whatever problem is out there. When you look at Agentforce, and for that matter, some of the technology that underpins it, including that acquisition they made a while back, is there a sense here that they can maybe be one of those companies that can successfully sort of stick the landing, if you will, with whatever this pivot is into AI?
Yeah, first of all, thanks for having me, Romaine. It's great to be here. The short answer is they have to. Salesforce has really staked their future on Agentforce and AI, and it's a really, really important time for them. Luckily, they were out ahead of a lot of other folks in terms of actually getting Agentforce and agentic AI into the hands of customers. What they need to do now is get beyond that initial adoption hurdle to broader production so that they can make those AI apps really sticky before other folks can get in there.
In the last earnings report, they talked about how something like 75% of their deals were included basically Agentforce or Data 360. And I am curious as to whether you see this as genuine demand or whether this is maybe just a little bit of a pull forward. I mean, how are you sort of assessing at least the numbers that we know already?
Sure. I think what we're seeing is customers are facing tremendous pressure to do something with the AI from the C-suite. Right? And Salesforce, because customers already have their data and workflows in Salesforce, are seeing an opportunity to do some quick wins there. I think what we're also seeing is really the shift in AI FOMO to FOMU, the fear of messing up, where people are like, I'll get this into a pilot, I'll get it into maybe a small use case, but I'm concerned about sort of turning it on and letting it run unfettered. And potentially either having it do something to my business or run up a big AI bill.
That's a really interesting point when it comes to FOMO shifting to FOMU, fear of messing up, as you put it. I am curious, how that sort of puts in impacts in practice. You talk about maybe scaled back ambitions. Do you think that eventually that could lead companies, some of these enterprise customers, to maybe spend less on AI?
Katie, I think what we're seeing is people really proceed with caution, and they're looking for vendors to help them with things like not just guardrails, but how do I deal with shadow AI? How do I make sure I have that sort of kill switch like Bill McDermott talks about at ServiceNow to make sure that if the AI starts doing something it's not supposed to do, that I don't have to be there to stop it. We can have some controls in place to stop it on its own. The reality is people are concerned about sort of waking up in the morning and finding out that AI is either run off and given customers a bunch of free products or done something else deleterious to their data, or run off in the middle of the night and run up a huge LLM bill. So it's those kind of things that customers really want to feel comfortable. And that's why it's really interesting to see where, ServiceNow, as I said, is going with Control Tower. Some of the stuff that Okta, who's announced later this week, is doing around sort of identity management specifically for agents and those kind of security control governance features that are really, really important to get folks over the finish line from interesting pilots to real production value.
Well, I'm glad you brought up, Okta, because it's interesting. You talk about the sort of fear here that maybe AI will go rogue and run up these big bills that maybe the C-suite wasn't expecting. But, we're also seeing more and more concerns arise when it comes to cybersecurity risks, especially when you're talking about client data as well. So in addition to FOMO, I have to imagine that that is coming through as well.
Absolutely. And concerns about, do I have the right sort of granular levels of permissions and governance in place to make sure that data isn't leaking, that I'm not revealing information I shouldn't be revealing, but ultimately that I'm not posing a greater security risk, particularly when I think about things like prompt injection and outside actors.
So is this sense here as to where we're moving? Do you see, I guess, what I think would have to be potentially some degree of consolidation? If it's not attrition, meaning some of these companies just going away, the idea that some of them do end up getting absorbed into some of the competitors that do figure this out.
Absolutely. I mean, I think these sort of security areas are a really hot one for some of these folks that want to be enterprise AI platform players to pick up. Data is another interesting one as I think about some of the different acquisitions in sort of the data management space, the data cleaning. Business process mapping is another area where if I have a clear business process map, boy, it's a lot easier to accelerate that with AI.
All right, Rebecca, got to leave it there. Great to get some time with you. That is Rebecca Wettemann. She is CEO and principal of Valoir. Now, coming up, tech's AI debt binge. We're going to discuss with John Lloyd. He is global head of multi-sector credit and a portfolio manager over at Janus Henderson. This is The Close on Bloomberg. Well, it's another busy week for tech earnings with Salesforce, HP, Marvell, Snowflake, and Synopsys all due to report tomorrow. Now, those results keeping AI spending in the spotlight as tech's debt binge shows no signs of slowing. John Lloyd, he is global head of multi-sector credit and a portfolio manager over at Janus Henderson, joins us now. And John, I want to talk a little bit about a note that we saw from Barclays last week saying that when you take a look at the hyperscalers, they're on track to basically exceed issuance of more than $200 billion this year alone. We could see that number increase further in 2027. And the ultimate fear here, of course, is that basically the IG bond market won't be able to accommodate all of these financing needs. And I wonder whether or not those concerns hold water with you.
No, I don't think they hold much water. We've seen good inflows into the IG market year to date, and demand has basically soaked up all the supply that's come to market from the hyperscalers thus far. We do expect that the tech sector within the IG market will expand pretty rapidly here, and we're seeing wider spreads in that market to compensate for that issuance. But thus far, the market hasn't had any problems absorbing the supply.
So you mentioned those higher spreads, investors basically asking for more compensation here. Are those wider spreads an opportunity in your view, especially when you think about the market overall? Spreads have been incredibly resilient.
Yeah, I would expect spreads to, on the margin, continue to widen out. If you look at past episodes where you have a lot of supply to fund a CapEx build out, go back to the Spectrum days of wireless, and that sector, when it generally expands in size, the spreads usually leak out wider in order to absorb that new issuance. I do think over some period of time it'll stabilize, but we're probably a little bit too early in the issuance cycle for the spreads to be stable from here.
I am curious, though, too, just about the elongated nature, potentially, of this. I mean, this does not seem like it's just a one-off. I'm talking about in terms of new issuance. The idea that we could see some of these types of sales for an extended period of time. Has that been factored into your general view about what the market's able to absorb?
It has. I mean, actually, earlier on, we took a differentiated view that CapEx spending would continue to increase this year from kind of two different components. The first one was just more token usage from AI companies, and then the second one is if you looked at the components that go into data centers, whether that's the chip pricing and all the technology, that is getting more expensive, and so you see the CapEx budgets, up to around $750 billion now for this year.
Yeah.
And that's up, you go back to early last year, that was in the, call it 550 area. So our expectations is, on the margin, that'll continue to grow.
I am curious just about some of the potential risks, if you see them at all. And one thing that sort of popped up was a deal that I saw where it was basically kind of a collateralized lending with the GPUs basically being the collateral. And I've asked this question of a lot of folks from your world about the idea of sort of how you underwrite collateral that potentially could be obsolete. I mean, we know how fast AI is moving. And I am curious that when you talk about the duration of whatever is being underwritten and the idea that the technology may have to be replaced in a year, 2 years, 3 years, who knows? How do you find the balance?
Yeah, I think there's two components there. The first component is many of those deals on the GPU financing side amortize down over the life of the contract of the GPU itself. So you're not really taking any residual value there. Secondly, if you look at secondary residual values, they've actually been increasing because we're in a shortage of chips. So in the near term, one, if you're amortized down, that doesn't really present a risk. If you are taking some residual value risk, generally speaking, right now, there's a strong secondary market for those chips.
And I do want to talk a little bit more about what we're seeing when it comes to software. Obviously, the talk of the town. We have big earnings reports this week, and we've seen the performance when it comes to the equity market and sort of this basically pair trade that has emerged, which is buy chips, sell software. How are you approaching that from a credit perspective, from a fixed income point of view?
Yeah, it really depends on what market you're investing in. The leveraged loan market has around 15% of the index that's exposed to software. And I think you have to be very selective within your software exposure. So we've been more focused on cybersecurity firms, system of records where they own the data. Those have been the two areas where I think you're a little bit more well protected and away from any app-based software. High yield, it's not really a big risk. The high yield index only has about 3.5% exposure to software. And if you think about it, AI exposure in the high yield index is almost up to 3%, kind of fully offsetting that as a growth driver.
All right. John, great stuff. John Lloyd, Global Head of Multi-Sector Credit and Portfolio Manager over at Janus Henderson. A closer look here at the burgeoning and quite frankly swelling debt space when it comes to AI. When we come back, we're going to talk real estate. We're going to talk alts. We're going to talk with Jonathan Goldstein, the CEO of Cain, about some of his latest transactions, some of his latest projects in the ever-evolving world of alternative asset management. That's coming up next here on The Close, right here on Bloomberg. New York City office tenants continuing to flock to the very top properties. That's at least according to the CEO of Cain, Jonathan Goldstein. The firm just securing a $321 million loan for an office tower on 57th Street here in Manhattan, known as Billionaires Row. Bloomberg reporting that the transaction could value the property at more than $600 million if certain leasing milestones are reached. Pleased to say the CEO of Cain joins us right now, Jonathan Goldstein. John, great to have you back here on the program. Of course, all eyes were on that deal, which we learned about last week here. Give me a sense here as to what your take is on the state right now of the high-end real estate market here in New York City.
Look, I think that we have been believers since the very beginning, since the narrative changed around COVID about people not being in the office, that if you provided the best facilities in the best locations, then people would continue and would want to operate from their offices. We've seen it in New York with our office on 57th Street. We've also seen it in Miami with our office at 830 Brickell, which has over 600,000 square foot, fully leased, hitting record rents well over $200 a foot. So I think this narrative of the office tower being finished was the wrong one. But I think there's a clear demarcation between new, purpose-built, highly specified office blocks and those that don't have the same facilities and I'm afraid, have a very much more doubtful future.
I am curious, though, and I do just have to ask you the question that is on everyone's mind. That was some of the potential changes in New York City laws and regulations with regards to real estate, taxation, and things like that that have been proposed by the current mayor. Does that not scare you at all, particularly given some of the threats that some people have made that they would leave New York City? And I don't mean just in terms of as a residence, but also in terms of moving their businesses out of the city.
What is clear, Romain, is that the political case for New York has to be made with the same seriousness as the commercial case. And I'm not sure we're seeing that in New York at the moment. New York is one of the world's great cities, but great cities don't stay great without effort. And they cannot assume that capital, talent, and enterprise will remain committed regardless of the signals being sent. And when you have someone as serious as Ken Griffin questioning whether New York remains the right place to commit billions of dollars to a major office project, that's a signal that the city has to take seriously. And I'm afraid that some of the gimmicks we've seen from the mayor just indicate that he does not take these issues seriously and does not understand the markets and the people with whom he is dealing. I'm afraid that, we've seen this across various of the major cities of the world. In the same way, you see a version of that conversation in London, where changes taxation for people working and living in London has meant there has been an exodus of talent from the UK over the same period. So I think that the two things can be true at the same time. There is an affordability issue across many cities around the world, which has to be dealt with. But you can't do this unless you're doing it seriously and without gimmicks. And in my view, that needs to be in cooperation, in partnership with the great businesses in those cities.
Well, compare and contrast, what you're seeing when it comes to New York, especially when it comes to, how companies are operating there, to Miami, for example, where you have a presence as well. Because when it comes to office space specifically, are you seeing any differences in the willingness of tenants to pay up for that sort of top tier Class A space, which seems to be, of course, the bright spot of the office space at this moment?
Well, Katie, let's start with leadership in those cities and in those states. And what you've seen in Miami and in Florida over a long period of time now has been stable, consistent, focused leadership on promoting the businesses and the cities within their environments. And what we want to see in New York is something very similar. In California, we've had very many narratives which have led to people questioning California. And we're fortunate within our Beverly Hills development that we've seen great leadership within the Beverly Hills environment, which contrasts to some of the rest of the leadership within California. So I do think it's an issue of leadership. Where the leadership is right in a city, the infrastructure and the facilities often follow, and they're often at the top of the class. And what we're seeing in Miami is the benefits of that. But New York is resilient. New York has endured many, many cycles and many, many situations. And New York will always be the winner. But it might well take some short-term concerns because of the lack of serious political leadership at this point in time.
And John, I have to assume, that sort of narrative that you're painting extends beyond office space when we're talking about New York, maybe that short-term pain, also to, the luxury consumer who also is buying residential real estate in New York as well.
Well, look, people have the right to choose where they wish to live, and they wish to live in an environment where they feel welcomed and valued. And that doesn't mean, that doesn't matter how rich or poor you might be. You want to live in a world and an environment in which you feel valued. So I think that there is messaging that comes out from the top of a city, which attracts people, attracts the right talent, attracts people to want to live and invest in those cities. And I think it's really important that people take a step back and understand what needs to be done to attract those people and attract that talent, because if you do that, then everybody benefits.
John, I do want to ask you a little bit about a couple of your projects. Obviously, the one Beverly Hills is kind of the one that everybody is focused on. You closed the $4.5 billion in construction financing for that a few months ago here. What is the timeline, realistically, that you think that is going to actually be done and up and running?
Well, we're working very hard to get everything up and running, up and around the Olympics in 2028. Some of the residential towers may be a bit beyond that, but we're working very, very hard and we're focused to achieving that. The retail will certainly be open before the Olympics in 2028. And we've had great demand from retailers who wish to join us in that venture. Some of the world's leading retailers have either signed with us or are in conversations with us at this point in time. So we're seeing great demand for our products because we're bringing something unique. We're reshaping Beverly Hills. We're bringing a new entranceway, a gateway into Beverly Hills. And we're giving something back to the people at the same time, because we're giving back almost 9 acres of public parkland for people to enjoy Beverly Hills and really to enjoy the environment that we're creating within Beverly Hills, which is absolutely unique.
I'm also curious about, and you mentioned 830 Brickell down in Miami, which of course has been a hot real estate market. I am curious about the refinancing on that, the $630 million, which replaced that construction bridge loan. I mean, what exactly is the demand and appetite right now in the refinancing market, specifically for these kind of trophy commercial properties?
Look, we've been fortunate both in Beverly Hills and obviously the facility that we announced last week on West 57th Street to have been backed by JP Morgan. Goldman Sachs led our refinancing at 830 Brickell with a CMBS, as you quite rightly say, of $630 million. I think what you're seeing is that institutional capital is attracted by best-in-class assets. In Miami, we have an amazing roster of finance, law, and technology clients who are our partners in the building. We're seeing great traction within West 57th Street, and we're seeing great demand in Beverly Hills. So I think if you have a best-in-class asset, then you will find that institutional capital is attracted to those. And we've been very, very focused, Todd Bowley and I, since we created Cain, has been to focus on gateway cities and best-in-class assets, and we're seeing the benefits of that at this moment in time.
But what are you doing different, Jonathan, over at Cain with regards to the way that you underwrite some of these deals? Because, I mean, we've seen a lot of the big players, the Blackstones and Apollos, Ares, have kind of moved into this space as well, primarily because of all of the upside benefits that you've just been talking about here. So what is your approach that, I guess, to a certain extent, separates you from them?
Well, I think we've had great conviction about gateway cities. Be that New York, be that Miami, be that Los Angeles, be it the Raffles that we built in Boston. But when you look at the office block on West 57th Street, we started that process just before COVID. But we decided halfway through COVID to carry on the process because we did not agree with the narrative that the office tower was finished. And we believe that if you built the best product in the best location, then tenants would come and the value would result. So what we've done is we've been laser focused on the gateway cities, the great cities of this world, London, Los Angeles, Miami, New York. And we can really double down in those areas. And what we're finding is that bet is paying off because of the resilience of those markets.
All right, Jonathan, really appreciate your insights as always. Jonathan Goldstein there, the CEO of alternative asset manager Cain. Katie?
And of course, we were just talking about some of New York's wealthiest residents, and they might be some of the few who are able to afford a ticket to the NBA Finals. Online marketplace TickPick noting games 3 and 4 at MSG are the most expensive NBA Finals tickets on record. Bloomberg's Randall Williams joins us now. And Randall,
what's game 1 and 2 like?
Yeah,
Can I afford that?
Well, talk to us about that. I mean, when we talk about expensive, how expensive are we talking here?
Well, it's a bit early right now. I think these tickets are going to go for several $1,000s, specifically at MSG. Whether they're in San Antonio or Oklahoma City for games 1 and games 2, those will be expensive. But at the Garden, it's going to be a completely different level. I expect Super Bowl prices.
Oof.
Okay. Well, I mean, this is kind of a Super Bowl type of city, at least in terms of the wealth. So I assume somebody is going to absorb that. But what's driving this? I mean, I never know whenever I see these crazy prices, whether this is sort of artificial, that, maybe, I'm a conspiracy theorist.
Sure.
I assume James Dolan just has like a bunch of tickets like in his closet that he's hoarding from everybody right now. But no, in all seriousness, what actually drives the price?
Well, number one is the nostalgia impact.
Yeah.
The Knicks have not been back to the finals in over 20 years. And so now that they're back, there's a bunch of excitement in the city that we can all feel as we walk throughout it. And then if the Spurs go, then there will be a whole nother level that is going to be reached because of Victor Wembanyama, who is 7'4". I remember when I interviewed him, there's a picture of me who I'm 5'9.5" standing next to him. I look like a midget. And so with that in mind, The Thunder, on the other hand, are going to drive prices, but not maybe to the level. So we have 2 games left.
I can't watch the Thunder. The flopping is killing me here. I mean, what's going on?
Yeah, we'll take your call to the NBA.
So I do want to talk about how this does compare to maybe years past, because the NBA Finals always a big deal, but it feels like, especially when you break down the different potential matchups here, the nostalgia of the Knicks actually being in the game here, that this is particularly unique.
Definitely. I mean, again, if you think about last year, it was Oklahoma City versus the Indiana Pacers, 2 mid-sized markets. This is the #1 market. So no matter who they play, if they play the defending champion in the Thunder, it's a story. If they play the San Antonio Spurs will be fresh off beating the defending champion. And so because of the fact that New York is the #1 media market, the interest is going to be astronomical. Whether they win games 1 and 2, they lose both, fans are going to have an appetite regardless.
Speaking of fans, New York, Philly, Boston, which fans are the most insufferable?
My personal take would be Boston.
Yeah.
Just because they've won the most.
Good call, yeah.
They've won 17 championships. You would also, they've won 6 Super Bowls.
Yeah.
They just don't really lose a lot. Their losing periods don't last very long. The rest of us, you think about the Knicks. The Knicks hadn't been to the finals for over 20 years. Boston has won 2 championships in that time.
Yeah, as someone who's still a Chicago Bulls fan, this hurts my soul. But I have to say, I remember last year when it looked like they were going to really get a taste of the finals. I mean, just the energy you could feel in the city and the excitement. And you kind of feel that this time around, no matter whether they win or lose.
They're playing the best basketball across any of the teams that are left. The remaining 3, the Knicks are the hottest. But the question is now, with these 10 days off or however many days off that they're going to have, will they be able to walk into enemy territory game 1 on Wednesday next week and keep the same energy and then bring it back here? Because let me tell you, if the Knicks are able to close at MSG, I don't know if there's going to be a sporting event like the NBA Finals ever again, just because of the atmosphere.
Yeah. All right, Rand, we got to let it go. We didn't get a chance to talk about what a prescient deal that was for Jalen Brunson a couple of years ago, that $100 million deal. Randall Williams, who covers everything sports for us here at Bloomberg. Katie?
Let's take a quick look at a notable mover from today. We've been talking about it the entire show. Micron officially closing about 19% higher, topping $1 trillion when it comes to its market cap. We know that it did get that upgrade from UBS, also got name checked by the president on Friday, all basically adding up to that big number on your screen right now. Let's take a quick look to some of the after hours movers as well, since we did get earnings from Zscaler going over like a wet balloon, down about 16% after hours, tracking down. You also see Okta and also Palo Alto down as well.
I've never tried to wet a balloon.
Please don't. This is The Close on Bloomberg. Logistics players push to take on Amazon. Tech startup Stored raising $250 million in a new funding round, valuing the firm at $3 billion as the Atlanta-based company looks to expand its fulfillment operation. Sean Henry, he is co-founder and CEO over at Stored. He joins us now. That $3 billion valuation, I will point out, it's doubled in less than 12 months. So quite a feat here, Sean. Talk to us about this latest raise, though. This is your Series F. What will this latest capital raise go towards at Stored?
Yeah, no question. $250 million at $3 billion is a lot of money, and doubling from last year is a great milestone for us. But it also reflects the pace of our business. Our revenue has doubled in that time, and our output for customers has grown even faster than that. This round is really just signifying Stored's market leadership as we build out the physical intelligence layer for commerce. And what we mean by that is all of the physical infrastructure, all of the software, all of the applied robotics and AI that powers a best-in-class post-checkout experience for independent merchants. Stored now runs almost 100 facilities globally, shipping packages to nearly a quarter of U.S. households every year. And we want to give independent merchants of all sizes all of the software, all of the AI, and all of the physical delivery they need to compete with Prime.
And, you know, as you mentioned there, compete with Prime, there's been a lot of folks, a lot of companies that have tried to compete with Amazon and that have failed, because what a behemoth to toe the line against. So talk to us about the strategy at Stored, what you think really truly differentiates you here.
Absolutely. When I say compete with Prime, what I really mean is enabling independent brands to have that same consumer experience on their own channels. If you as a consumer step back and say, why does Amazon now control about a third of US e-commerce? We at Store don't believe it's because they have a better storefront or payments or ads than the next guy down the road. We believe it's because we trust their deliveries as consumers. And that's what we want to enable for independent brands. And so we've really started with the back end, doing the heavy lifting for a decade now, to where today we power over $15 billion in commerce for over 1,000 of today's leading brands. And what we've been able to do is build the scale, the vertically integrated software, and now apply next-gen robotics and AI to deliver the fastest, cheapest deliveries possible for these independent merchants. What we're doing with this round is launching Stored Labs, which is taking that investment even farther.
Yeah. I am curious with regards to this build-out. Should we anticipate additional acquisitions with regards to the actual use of that money?
When you look at our network, we've used acquisitions to expand our footprint rapidly. We now power almost 100 facilities globally, about 20 self-operated, and about 80 sites running on our technology to ship for our customers. And as we look out, logistics is one of the most legacy. It's been around since the dawn of trade and commerce industries out there. And so there's thousands of independent, mid-sized mom and pop businesses, self-run warehouses. And what we've been able to do through acquisitions is often apply our next generation software, applied intelligence and robotics into those existing fulfillment centers and customer bases to deliver even more Prime-like outcomes. I think the bottom line is it takes a lot of scale to be able to provide this, and that's what Stored is delivering with our playbook.
Well, that's kind of where I was going to, because I am curious just about the economics of this model. And I was looking at some of your acquisitions, and particularly one of the deals that you had, I think it was a few years ago, 4 years ago, for that Quiet Logistics fulfillment center. And I was just kind of curious, as if American Eagle can make that work, why can it work for Stored? Is it just a matter of scale?
It's all about independence. We believe that one massive marketplace, Amazon, has built this for themselves, and arguably so have companies like Walmart. But if you take independent retailers, like the example of American Eagle you gave providing this, it's hard to get the economies of scale as one merchant to provide that to everybody else. So if you look at what we're doing today, we're now taking the scale of, I say, about over 15, it's about $17 billion of front-end GMV. And it gives us the pricing power, the scale of about a $17 billion retailer to then apply into the network. And so we think it's all about kind of arming together all of these independent merchants, not one merchant building it for themselves.
And Sean, we only have about a minute left here, but as I mentioned at the top, this is your Series F raise. You're valued at about $3 billion. Are you having any conversations about potentially going public?
We think that this is a business for the long haul that's built to serve today's consumers. And we believe that's a business that can compound for decades ahead. I think the reason you're seeing so much investor excitement of growth investors, some of the best investors in the world piling in about $250 million to this fundraise, is because of how fast we're growing and how much they believe we can keep growing for decades to come, based on this foundational premise that commerce in America is driven by the back-end delivery. Who gives the most trust after you press checkout? And if you power that for everybody else, how big could that really be, ideally one day in the public markets?
All right, Sean, got to leave it there. Sean Henry, co-founder and CEO over at Stored. We'll be back in a moment, setting you up for what to watch over the next 24 hours right here on Bloomberg. All right, let's get you set up for what markets will have their eyes on over the next 24 hours, Katie, and it does include some earnings before the bell tomorrow.
Absolutely. We're talking about Dick's Sporting Goods, Abercrombie & Fitch as well. An interesting read on retail, and then we get some software after the close.
Yeah, Salesforce is obviously going to be the biggest one. A big read here on just how that software as a service model is holding up. We're also going to hear from Marvell, Snowflake, which of course takes on a different complexion given what we heard from Zscaler, Synopsys, and HP Inc.
And also at 7 a.m., we're also going to get MBA mortgage applications. Of course, a lot of focus there on the housing market. We're also getting Richmond Fed manufacturing data at 10 a.m. as well.
And we have a quiet period coming up soon for the Fed, but of course that means they continue speaking until then. Logan, Cook, Jefferson, and Goolsbee, at least 4 of the Fed members will be out with statements tomorrow. We'll cover all that for you right here on The Close. We'll be back tomorrow, right here on Bloomberg.